With more companies now coming out with forecasts of how the spread of coronavirus will affect earnings, it's becoming clearer that the first quarter of 2020, at least, will see a slump in growth. Well, joining us now from WisdonTree is Director Nitesh Shah. Nitesh, good to talk to you. Thanks for coming in. It's a difficult one, isn't it? Because we don't know how far into the crisis we are. I mean, I talk about Q1 there. We could be talking about this in another 3 months' time for Q2. We don't know where the bottom is. How are you approaching this as someone that monitors the markets?
Yeah, you're right. We don't know exactly how long it'll last. It could be a very quick recovery or it could be something very prolonged. There is that source of uncertainty which is causing market jitters at this point in time. But we believe that, market uncertainty is not something, it's not a novel phenomenon. We've seen uncertainty come before. In many ways, we think of this almost as a black swan event. A few months ago, this was on nobody's radar, but today it's on everybody's radar. It's just come out of the blue, supposedly out of the blue. But if you go back to last year, you would see like the World Health Organization or UN report saying, we're due an epidemic of a large scale, and obviously now it reads like a prophecy. But in terms of how markets are reacting, basically there are replacing cyclical assets with more defensive assets, and gold is one of the primary places that markets are going to. Treasuries are also something that are in favour, and we've seen treasury yields fall to an all-time low.
In terms of the defensive plays, gold I want to pick up on particularly because if we bring up a gold chart, to my mind, the beginning of the week, it was looking as though, or late last week with this uptick that we saw, it was looking as though we were going to end up past 1700. But in the last 4 or 5 days, it's fallen at a time when we've seen this almost precipitous drop for some of the global benchmarks, and of course a big rise in volatility. Now, those are two indicators, for me at least, we potentially see a rise in gold, but over the last week or so we haven't. What is it that's going on in gold at the moment that leads me to think that perhaps maybe gold is not behaving as it should?
Yeah, I mean, gold has had a fantastic run since the beginning of this year. I think over the last few days it's just taking a pause. We've seen speculative positioning in gold futures hit an all-time high. And when that happens, very often people are taking a little bit of profit, pulling back a little. But if we look at the sort of fundamentals that drive gold prices, things like the interest rate environment, if you look at inflation, if you look at the positioning data, if these things remain as they are today, so spec positioning close to all-time highs for the remainder of this year, if inflation, as in the US, remains at around the 2.5% level, if the treasury yields remain as low as this, close to below 1.3%, we could end up at the end of this year with gold prices over $2,000 per ounce. That will be an all-time high. So if things remain as they are today, I think this is just a very temporary pause and gold prices would see a melt up.
One of the other effects on the markets have been, for me, an indicator potentially as to how bad growth is potentially going to be in this first quarter, is the price of oil. We've spoken a lot before about oil, and I was reporting 2 or 3 weeks ago that OPEC was looking to try and persuade OPEC Plus, the non-OPEC nations, to join it in cutting oil production. But that hasn't happened, and as a consequence, it's seen this drop-off. Do you see a floor in the price of oil being established anytime soon?
Yeah, so next week, OPEC and its partner countries, OPEC Plus, are meeting on the 5th and 6th of next week, and I believe that at the end of that meeting, they will come to a policy cut, and they'll probably cut by more than the technical committee recommended a few weeks ago, which was 600,000 tons. There were Russia, as its OPEC's largest non-OPEC partner, seemed to be very reluctant, but I think the tables have turned a bit. The market has shifted significantly over the last couple of weeks. People are fearing a massive destruction in demand, and I think Russia will be ready to act at the end of next week as well.
Those 600,000 barrels, is that enough, do you think, to curb prices? Or, I mean, this, as we've said, there's so much unknown here.
Yeah, I don't think 600,000 will be enough. I think OPEC will act in somewhere closer to the order of 1 million barrels per day of cuts. And that comes on top of the 2.1 million barrels of cuts that are already in place. A lot of that may become as a result of Saudi Arabia taking on even more voluntary cuts. But Saudi Arabia's position has historically been, as long as everybody is willing to cut a little, they will cut more.
Yeah. What about agricultural or food prices, I think, generally? One of the headlines, again, that we've seen, in fact, out of China recently, was a big spike in inflation and food prices, which, of course, is presumably all down to lack of supply. Do you see that being the pattern over the next few months across the developed markets, Western markets?
Yeah, I do think that supply chains will be disrupted as a result of what's happening right now. We can see in many different markets, whether we talk about manufacturing or other types of industries, we are seeing supply chains disrupted, and I can't see that agriculture will be immune to it. But you could get sort of localized weaknesses because you'll see surpluses of certain crops that can't be exported. So big export markets like the US, who produce a lot of agriculture for export markets, may see some localized weakness in prices. So the global picture will be somewhat sort of fragmented. You may see spikes in food prices in one country, whereas depressed prices in other countries.
Okay, let's put all this together and bring it through into the idea about what central banks are going to do. I was looking at the interest rate futures for the Fed. I noticed actually just an hour or so ago from the point of this interview that I think it's like 84% of the market was expecting now a cut from the Fed of 25 basis points the next meeting. Is that going to be enough? Will the Fed move, or will they wait, do you think, and perhaps maybe add a little bit of extra caution?
I think central banks would always wait for more data before they act. And I think they realized if something's the nature of the shock is a virus. Usually viruses can't last for many months, so they should see this as transitory, but they in their capacity should be acting as a shock absorber in this environment, so that it doesn't become a prolonged issue and inflation expectations don't become entrenched. So I think that ultimately central banks will act. The Fed, ECB will follow the steps of the PBOC and the Bank of Japan. So I think there will be some reaction here, but right now I think the central banks are downplaying things. Lagarde yesterday downplayed the ECB's reaction, but ultimately they will react. We just haven't had enough data at the beginning part of this year for them to act decisively. But we will get a whole host of PMI data coming out next week, and I think that'll be very telling. Yeah,
of course, that's going to give an up-to-date picture as well. But you mentioned Christine Lagarde at the European Central Bank. I mean, she's sitting on a very precarious position because they've already got negative interest rates in some parts. They are pumping money into the economy. What else can they do? I mean, we've seen recently the Hong Kong Monetary Authority start to pump money in, and it has had an effect. And Japan is, as you say, doing something. The US have got higher interest rates they can cut. But what is in the armoury of the European Central Bank?
Yeah, so the interest rate course, is very limited, but we know that central banks have been engaging in quantitative easing of various forms in the past. They can deploy more of that. They can widen assets that they buy. They can loosen the criteria, the credit criteria on the assets that they're purchasing. So there is a lot more arsenal in the ECB's toolbox. But we also know that the ECB is going through a strategic review. Would anything that's coming out of this strategic review be accelerated as a result of hitting another potential short-term crisis a lot sooner than they originally anticipated?
Just one final question. I was reading through your most recent report, and you talk about defensives, where there is an opportunity here in the market as things stand. Or are you just standing back and waiting for the opportunity to get back in?
So I think defensives are a clearly something that the people should think about putting into their portfolios. So gold, as I mentioned earlier, has been a clear winner in this environment. People have been paying attention to what's happening with gold. People who had underinvested in gold in the past are now seeing the advantages of it being an insurance asset into our portfolio. As I mentioned, these these kinds of black swan events, no one can predict when they'll happen. But if you have a defensive asset like gold in your portfolio, when they do occur, they perform well. And quite frankly, they don't perform that badly in normal times as well. So it's not that much of a drag on your portfolio in other circumstances. So I would say that that's the kind of approach to take. That you put, so it's almost like a barbell into your portfolio. That you position yourself for growth, because that's what the normal course of activity will be in any sort of healthy economy, but have some defensive there. Now, if you think that gold has possibly extended very quickly over a short period of time, there are other commodities that move very closely in line with gold, like silver and platinum. They have very strong correlations with gold, and are likely to see an uplift in the next few months as well.
Yeah. Okay. Well, let's hope when we get you back in, we'll be talking about some more interesting and better times ahead. But in the meantime, thanks indeed for dropping by. Nitesh Shah there from WisdonTree with an update of where the markets are and opportunities as things stand at the moment in the context of the spread of COVID-19.